Welcome to the Utah Retirement System's webinar series. While this webinar has been pre-recorded, the information is still relevant. Please see the description below for links to the different sections within the video and other helpful information. We hope you find this webinar to be a useful resource in your retirement planning.
First off, I want to say thank you and congratulations to the group that are tuned into this webinar. You're the people that are doing what you can to educate yourselves, take what control you have of what at times might feel like an uncontrollable situation. My goal today is to go through a few of the tools that we use as advisors. I've been in this business since the late 90s, around 97 or so. So we've seen some bad markets before, granted. We haven't seen a pandemic before, and the resulting drop in the markets and the economic questions that are out there. But the tools that we're going to go over today are going to help you regardless of what's coming at us. There's different theories of thought, there's different ways of doing what we're going to discuss, but what I want to do is take a 30,000 foot view, if you will. So we're going to take a big picture approach on our on the three investing principles that hopefully you can take with you today, feel more informed, and make better educated decisions. All right. So just switch the page here. These are the three tools that I'm going to talk about today. One is asset allocation. The second, diversification. You might think those are the same. A lot of people do. They're not, and we'll get into why. And then finally, one of the most powerful tools that you have, particularly as a 401k or Roth IRA, as a consistent investor. Okay, so let's start off with our asset allocation piece. There's four main ingredients. Anybody cook out there? Anybody, there's certain things, certain staples that you go to make different types of things happen. Whether it's in baking, whether it's in cooking, I'm not much of a baker. I'm a very good eater, but I'm probably not the best baker. My wife is a great baker. There's always eggs, flour, sugar, salt, some combination of those that go into making most of the things that she bakes. So I want to focus in on the four main ingredients of investing. And a lot of you hear these. I'm going to try and stay away from buzzwords for the most part. I don't even like using the term asset allocation, but it's what it is. So it's just don't put all your eggs in one basket. And not even just don't put all your eggs in one basket, have a few different baskets, is what I would say. So let's take our 30,000 foot view. In this industry, we love our pie charts, our pie graphs. So you can see here the four main ingredients for asset allocation. There's a few different ways to make money. These are very basic. You can own something that makes money. You can loan money and get interest, kind of like how you do with the savings account. You can have real estate. That real estate is hopefully going to go up in value over time, and if it's a rental or a leasing property, is going to pay you some income along the way. And then finally, cash. All of these do different things for you, as you can expect. And the reason we have different types of investments, these different types, is because they will all act differently in different situations. So initially here, we're talking about the own. A lot of people don't understand that when you own stocks, you're owning parts of a company. So if you own stock in Apple, you own part of Apple. You might own 1/1,000,000th of Apple if one share is or even less, but you do own part of that company. As an owner, you're entitled to a share of the profits if the board approves profits to be paid out, and those are dividends. Most people, though, are going to own stocks because as that company makes money, sells more iPhones, sells more widgets, whatever, more people will want to own that stock. Okay? When more people want to buy the stock or own that company, and there's only a finite number of shares in that company, the price of that company will go up. Okay? That means you have more buyers than sellers at that time. So in order for an exchange to happen, you have to have a buyer and a seller. So a lot of times we look at our stocks and say they're worth such, and that's great, but that is a snapshot. And unless you sold at that price, that isn't what you got for that portion of the company. But it's good to see as a measuring stick in terms of, okay, is my company on the right track? Is it making money? Are more people still wanting to buy this than sell it? The flip side is when more people want to sell than buy. That obviously is going to drive the short-term price down. That's what we've seen here in the last month or two. Okay? That owning stocks, and because there are so many stocks out there moving at literally the speed of light in terms of trades and things, you'll notice you don't see too many people down on the trading floors on TV. Most of it's done with a computer. And actually, most of it's done with computers in New Jersey rather than the stock exchange, but that's another discussion. But you've got a lot of shares trading hands very quickly, and the computers are matching up buyers and sellers all the time. Okay? But when you get more sellers than buyers, you're pushing prices down, or they're being pushed down. So if you wanted to sell your stock, yesterday it was worth 30, now you want to sell it, you can put an order in to sell and say you won't pay less than, or won't take any price lower than 30, but as that price continues, as orders continue to fill for people willing to sell at less than 30, it's going to move further away from your price. Okay? It's just like with anything, stocks can be bought and sold, just like cars and homes and everything else. It's just that with stocks, it's such a liquid market and so many people are doing it at the same time that it's very, very visible. And the effects are very immediate. Okay? So thankfully, we don't have a second-by-second play on how much someone would pay for your home if you went to sell it right then. It may be that in that moment, no one wants to buy it. You have a pretty good idea what it's worth, but until someone pays you something and actually takes ownership of it, you don't really know what someone's willing to pay you. You get an idea based on what some of the prices are people have been getting around you. And that's kind of what stocks are. They're going to move in kind of a herd direction, kind of a herd mentality. Okay? But you want stocks. Stocks are the big drivers of our economy, of capitalism. Owning companies and having companies that make money and pay employees and help us put kids through school and pay us a wage, that's what our economy is based on. Okay? So stocks are a big portion of it. Second, loaning money. If you can think of a savings account, you put your money in the bank, you're effectively loaning that bank the use of your money until you need it. With a checking or a savings account, that can be very immediate. So you can deposit your money one day and then go take it out the next day. However, you're not going to get much interest. And granted, interest rates right now are relatively quite low. They have been for quite a while. So if you give your money to a bank in the form of a savings or checking account, you're not going to earn much interest. There for a few years, I didn't see any interest on my checking and savings accounts. The past few years, I've seen a couple pennies sometimes, but not much. What a lot of times banks will do, one step up from a savings account, is what's called a CD. And that's a little more like a bond. Okay? That is essentially you giving your money to an institution. And just like you and me, institutions have credit scores. Okay? You've heard of probably Standard & Poor's or Moody's. These are the companies that assign credit ratings to different companies. So if you're okay, I don't need $1,000 here, what you can do is you can loan that money to a valuable company. Maybe it's a Microsoft or an Apple who has a company that has a lot of cash. They're very stable, but they need some money maybe to cover a project or to cover some marketing costs or something. They don't need it for a really long time, but they do need it, say, for a year. Okay, you could take out, or you could buy a bond. They're going to pay you some interest, and that interest is paid every 6 months, typically on that bond. And at the end of the year, you get your principal back. There are multiple thousands, millions of bonds out there with different maturities. So you can have it in there for 1 year, you can have it in there for 30 years. You've probably heard of treasuries. Treasuries is that's the government essentially using your money for whatever operations the government needs, whether that's infrastructure, whether that's helping fund this coronavirus issue. The government will pay you interest to use your money while they're using it. Okay, so governments, corporations, these are the types of bonds that you're going to have. There's also some companies that might have lower credit ratings. In order for them to get a loan, they're going to have to pay more interest than a company that might be in better financial condition. Okay, so that's where you can make more money. However, they have a greater risk of not just not paying back that money, but when things go south or when things get tough in any type of market, the demand for these higher risk securities goes down and people want safety. Okay, so when anything like this happens, just like you and me, we hunker down. We're not spending as much money as normal. You're worried about what money you have out there, and you just want it in cash. And that's what the markets have done, both with stocks and bonds in the last month or two. Now, bonds, not nearly as sharply, not as dramatically, but they also went down. But it's probably more temporary. All bonds have a par value that they come back to, that they're going to mature at, and then they also have the interest that they pay over time. Okay? Real assets, they're exactly what they sound like. They're gold, silver, they're commodities like corn and soybeans, and I grew up in Idaho, potatoes, things like that. Also real estate, that can be land, raw land, that could be a building complex, it could be a portion of a building complex. You might own shares in that. And as a result, you're going to get lease income while you're owning that real estate. Plus, you're hoping that that real estate goes up in value over time. Okay. This also has had some shock to it. When things like this happen, the normal course of events, it's like our fourth option, cash, just becomes a magnet and tries to bring everything in and keep everything safe. It's a normal human reaction. Okay. The issue is that when money comes out of these other assets and goes into cash, that affects the entire economy. This is all going to work through. I don't know how, I don't know what. I'm sure that there's going to be some things we don't see coming as a result. That has always been the case. That has been the case since the stock market or investments or anything has been around. Okay? We're all still going to need homes. We're going to need clothes. We're going to need cars. There will be demand. It will pick up. But right now, it's been this shock to the economy. Okay? So right now, most everything's sold out, went to cash. People are hunkering down. But having these four main ingredients, still having them there, are still a critical part to have in your overall retirement plan, particularly if you have a long time until you anticipate retiring. By long time, I mean, double-digit years, 10 years, 8 years even, 20 years, whatever. You want to have things that you anticipate going up over the long run. You want some aspect of these ingredients to be in your portfolio, okay? So that's the 30,000-foot view, so to speak. All right, let's go on to our second tool. By having this tool, these four main ingredients, this is how you can build wealth, regardless of whether things are going up or down. So let's zoom in a little more and talk about diversity. if I just to switch back real quick, you can see there's a big category: stocks, bonds, real assets, and cash. Let's zoom in a little bit. There are different types of stocks, different types of bonds, different types of real assets. Okay? Question's going to pop up here. If you would all take a minute and just give me your impression of or what your answer would be to this question. And right or wrong doesn't matter. No one's going to see it. You're all good. No one's getting graded. I've got 3 children at home. I've been helping with homeschool, and yeah, you all might be used to helping with that type of thing. Best of luck to you. But looks like their answers are coming in here. This looks great. What we're talking about and what this question surrounds is mutual funds. So a mutual fund, you'll notice I didn't list that in our 4 main ingredients, because a mutual fund will, and it depends on the type of fund, is a combination of assets. It might have all 4 of those assets in it. It might just have stocks, or mainly stocks with a little bit of cash or something. So there's lots of different types of stocks as well. There may be some mutual funds that only have small Chinese oil exploration companies in there. Don't know if I'd want to own that right now, but it can get very granular. It can get down into the weeds a little bit. On this slide where it says diversity matters, it talks about you can see the pattern that is existing within this chart. This chart goes back to 2008, a wonderful year. It was a very tough year for most of us, and it looks at different asset classes. Okay, so not just the asset classes, but even this, what we call the subclasses of funds. Here we are looking specifically at the funds we have in the URS portfolio, not the target date funds necessarily. These are our core funds. All of the core funds, however, are rolled into the target date funds, which I'll get to in just a moment. So a lot of folks will look in the guide there and say, well, I just want the fund that's done the best. So in 2009, you'd go in, you'd buy that large cap, and cap, whenever you see cap, that means size. So large size stocks, big companies, your Microsofts, your Apples, your Google, and Facebook, and not just tech, but very large companies that are multinational typically in scope. So here you'd say, well, I'm going to pick the large cap stock growth fund, but it didn't do the best every year. A lot of folks who haven't done a lot of investing, and this is normal because you don't have much else to go on, will just go with whichever one looks like it's doing the best at the time. So they might put all their money in that large cap stock growth fund. And it's a very good fund. It's a great fund. However, you've only got one piece of the investment world, or one slice, okay? We also have an international fund. And just as you'd suspect, this owns companies that are overseas, foreign. We also have a balanced fund that I'll come back to. That's a combination of stocks and bonds primarily. Okay, so stocks, bonds, and some cash. Then you have our large cap stock index fund. That essentially is a computer-driven fund. If you've heard of the S&P 500 index, that looks at the 500 largest companies that do business in the U.S. and invests in those, and the computer matches that, and so it's all automated. Our income fund has very short-term bonds in it. Our bond fund has longer-term bonds. It's a little more diversified. Large cap stock value fund. These are also large companies, but maybe they've been around a little longer. Maybe they pay a more predictable dividend. Their profits might be more predictable. This is something like a Gillette or a Wrigley's Gum or Clorox or something like that that's been around a while that we're pretty familiar with. And then finally, small cap stock fund is just what it sounds like. It's smaller companies. So they may not have been around as long. However, because you're getting them while they're smaller, ideally there's a greater potential for upside, but there's also more risk. The one pattern you can see in here is if you tried to pick any of these funds to be the top performer in any one year, you're not going to do it, okay? No one section is the best for every single environment. What you can see, however, with a balanced fund, which takes an asset allocation approach, like we talked about, it has about 60%, 50 to 60% in stocks and about 40% in bonds, okay? It has, although it hasn't gone to the extremes, it's had a very good positive 10-year average of 8.8%. It's been up some years, it's been down, it's never been the top, it's never been the bottom. This is a good moderate way to invest and diversify your assets with different types of stocks and different types of bonds. This is pertaining to our balanced fund. However, any of you that have a target date fund, it follows this same principle, okay? So it will take all of these funds, combine them, and put them into one package for you in the target date fund, as well as a couple of other asset classes. You might remember I mentioned commodities and real estate. We have that in there as well, a slice of that. That's in your retirement guide in the, I believe it's pages 5 and 6, or 6 and 7, actually 6 and 7. It breaks out how much is in stocks and bonds, and then even in the individual funds. So by using a target date fund, even if you just use one fund, you're going to be spreading your money out over thousands of different types of stocks and bonds. Okay. All right. Let's move on. So that's moving down closer. That's breaking it out just a little bit more than just stocks and bonds, but the different types of stocks and bonds you should have. Let's talk about what, to me, and honestly, this is probably what got me started in this industry. I was going to college. Someone came into my finance class and they talked about this principle. All right. If you are contributing money on a regular basis, you're doing yourself a huge favor. You could take $10,000 or $1,000, or in our example here, you could take $500 and just get the same price every month in something. What I like to do is say you could invest $500 5 months ago and just put it in the market. The price goes up and down. So if I were investing, and I apologize, this graph isn't exactly my favorite for doing this, but if you just put the money in a specific amount and the price never changed over 5 months, you put in $100 a month, you'd have $500. However, if you're putting your money into something that does have a changing price over 5 months, so the first month there, you're getting it at $20 per share. The market goes down. Now you're going to get 33 shares of whatever, or excuse me, you're going to get 33 shares of whatever you were buying. So 20 shares, 33 shares, market goes up, you're going to get 20 shares again. Let's say it goes up the next month. It goes up to, you're going to get 14 shares. Although you're using the same dollar amount, $100 each month, you're getting either more or less shares depending on what the market is doing, what the cost of your security is. By doing that, in that 5th month, you will have more money even though you invested the same amount as someone who just put it in at a consistent price. So investor A, they're going to end up with $500. If everything they bought was 20, they got 20 shares, okay, for each one. However, investor B is going to end up with 107.6 shares. They're going to have more shares with a higher total value, 538. This dollar cost averaging, all it is just buying things on a regular schedule. So every time you get a paycheck, if you've got money going into the 401k or a 457 or a Roth IRA, and you've got that automatically going in, this last paycheck, you bought a lot more shares for your money than you did 2 months ago. So if you're a long way from retirement, that's great if you've got an asset allocation that has mostly stocks. you just bought a lot more for your dollar on that particular investment. So these types of downturns are kind of a once in a decade thing, and every once in a while they occur. And if you're adding money to your account on a regular basis, that's going to help you over the long run so that when you retire, you're going to have more money than if you'd just put in a lump sum. Okay? This is probably the best tool that we have access to, or most people have access to, by using a 401k. Dollar cost averaging works for you over time. Even if you're someone who's going to be retiring sooner rather than later, if you're using our target date funds, which I strongly encourage you to do if this isn't your thing. Some people like to mix and do their own portfolios, which I totally understand. But if that's not your thing, let's say you have a target date fund and it's very conservative, it's not going to go down as hard, nor is it going to go up as high. It's a little more stable. It'll be a lot more like that balanced fund I was showing you earlier, but even more so, without so much highs, not so much low, more predictable, can still go up and down, but you have a lot less stock in there. You have more bonds, more cash, and that makes things more predictable. Okay. Just a quick question here. Go ahead and answer this. If you're still on the call, if I haven't lost you yet, hopefully not. What do you think the average investor made between 1988 and 2008? Go ahead and answer there. Let those answers come in for a second. And I know there's people that weren't even born in 1988. That's fine. You could take this amount of time over a lot of different scenarios. Okay. Great. Appreciate your answers there. So how much did they earn over this amount of time? 1.9%. If you read that on the side, while the S&P 500 index earned an average annual return of 8.4 during this time frame, so the market, as we call it, earned 8.4%, the average individual investor earned an annual return of just 1.9%. That's sad. You that are on the call probably aren't going to be in that scenario. Let me tell you the situation for those who earned 1.9%. It's kind of like going up with your shopping cart. You're at Costco and you're trying to pick the best lane. So one lane looks really good. You get into that lane, then another lane starts moving. So you switch it over and do another lane, and you just keep hopping lanes, but you don't ever seem to be getting ahead. If you have a good asset allocation, okay, such as in a target date fund, you're going to make a lot more money over time rather than chasing what looks to be the best investment at the moment. So trying to time getting in and out of stocks to cash and getting back in, it's very difficult to do, and you've got to be right twice. You've got to get out before things head south, and then you've got to get back in before they head north, which I said, by the time you realize that that's the time, or the time you feel comfortable doing that, it's typically already moved past you, okay? Don't be like the typical investor. Don't try and time markets. Don't try and jump around. Go with a good asset allocation. Take the investor profile on urs.org and see what it suggests for your target date fund. You may not be in the ideal target date fund for you, okay? So be proactive and not reactive on your investments. That's when you get into trouble. Finally, this is the last slide I want to show you. It's a lot like what I just mentioned. A lot of people get hit and they'll go to cash. And so they'll say, I just want to get back in when all of this comes back around. By the time it comes back around, or they feel like it's come back around, it's too late. If you missed the 10 best days in the market, instead of having an almost 8% rate of return being fully invested, you'd have a 4% rate of return just by missing the 10 best days of the stock market. Okay. If you missed 20, you're at 1.5%. If you miss the 30 best days, you're at negative, you've gone underwater and so forth. You've got to have that money in there. It's not timing the market, it's time in the market. Have a good allocation, make sure it's diversified, and do the dollar cost averaging so you can buy at these low prices and get your bang for the buck.